Good morning, everyone. Thank you so much for joining us. Thank you for joining us. We appreciate you. We'll just give a few more minutes to allow others join, and then we'll start shortly. Thank you. Thank you once again for joining. So we'll just give one more minute to allow others join before we start. Thank you. Good morning, everyone, and thank you for joining us today. We'll be starting the session now. Welcome to another insightful Quadros webinar session. My name is Kofo-Rola Oyewole, Vice President at Quadros Well Team, where I oversee the delivery of bespoke investment solutions and long-term financial strategies to high net worth individuals and corporate institutions. And I also advise clients on financial planning and investment advisory, and I'll be moderating this session today. We are so excited to host this important webinar themed Building a Future-Proof Wealth Plan ahead of 2026 tax implementation, which is focused on understanding the tax implementation taking effect in January 2026. Over the last couple of months, there has been a high level of interest, sentiments, questions, concerns around how these changes may affect income, investment portfolios, and long-term financial planning. Hence, the reason why we decided to put this important webinar together. Today's session is to provide clarity, insights, and practical guidance to enable us all make informed decisions ahead of time. Before we begin, just a few quick housekeeping points. So this session is being recorded and the recording will be sent after the session. And during the course of the presentation, you can drop your questions in the Q&A box that you can see on your screen at any time. It will be taken after the presentation. Also, if you experience any technical issues, kindly let us know via the chat box. With me here today is the Managing Director of Quadros Wealth in the person of Doinsola Ola. Thank you very much, Doinsola, for joining. Without further ado, it is my pleasure to introduce our guest speaker for today, in the person of Mr. Suleiman Yahaya. He is partner, private clients and wealth and family wealth practice at Anderson in Nigeria, a leading tax and regulatory advisory firm. He has about 18 years of experience in tax advisory, family wealth, succession planning, wealth management services, and he has also assisted several high net worth individuals and families in setting up appropriate investment holding vehicles that ensure wealth preservation and transition to succeeding generations. In addition, he also has provided advisory services to several multinationals and clients in diverse industries on tax and regulatory issues, tax structuring, tax risk management, transfer pricing, corporate mergers and acquisition, startup, compliance checks and reviews, reorganization and recapitalization, and business restructuring. He is a member of the Institute of Chartered Accountants of Nigeria, ICANN, and also Chartered Institute of Taxation Nigeria, CITN. He brings an extensive wealth of knowledge in Nigerian tax policies, and we are so privileged to have him here with us today. Thank you very much, Mr. Suleiman. Thank you for joining. Please join me in welcoming him as he takes us through today's session. Welcome, Suleiman. You have the floor now. Thank you for joining.
Thank you very much, Kofo, and thanks to the Codros team for having me. And good morning to the participants. It's nice to be here once again to discuss one of the hottest topics, for 2025. Right. So just a few minutes, I will be sharing my screen. Okay, while the presentation is coming on, like Kofo has introduced me, my name is Suleiman Yahya, and I'm a partner, with the private client practice at Anderson, Nigeria. For those who may be familiar with Arthur Anderson of those days, Anderson, Nigeria is the successor firm to Arthur Anderson in Nigeria. And basically, in Nigeria, we are a multidisciplinary professional services firm rendering a wide range of services from tax to business advisory services to transfer pricing to oil and gas services. We have presence around the world, from Europe to America, South America, Africa. We have footprint in about 45 countries in Africa, and with presence everywhere around the world. Okay, so today we have just about maybe 1 hour just to look at what has happened, and so we've decided to keep it very short and straight to the point. We also believe that there will be a lot of value in the conversations that will happen, so I will not seek to extend this presentation for too long so that we can have enough time to, to discuss. So in simple terms, we'll just be doing three things. We'll look at overview of the Tax Reform Acts themselves. We'll look at the key changes and their implications. And as you'll imagine, because of the magnitude of changes that have happened, there are quite a number of changes, that have been introduced in the new Tax Act. We will not be going through all of those changes. What I've just done is to identify a few of those changes that I think will be material and important for the category of people that we're speaking to. And of course, we'll look at their implications. And after that, we'll then go into Q&A session. So just to summarize, I believe for the most part, almost everyone will be familiar with what has happened. But what we're doing with this slide is just to more or less summarize what exactly it is that has happened. So prior to the Reform Act, we had quite a number of tax statutes that governed the administration or the imposition and administration of taxes in Nigeria, right? So you will have your company's income tax, personal income tax, petroleum profit tax. I mean, it's quite a lot, right? So what this reform has done is then to consolidate all of these tax acts into four main acts. Which is the Nigerian Tax Act, Nigerian Tax Administration Act, the Nigerian Revenue Service Establishment Act, and the Joint Revenue Board Act. right? So in summary, if you are looking for, you know, information about what income should be subject to tax, all of the tax, be it income tax, VAT, or whatever. I mean, all of those tax head, you will find, that kind of information in the Nigerian Tax Act, right? The Nigerian Tax Administration Act basically provides, rules as to how the tax administrators will go about administering these taxes. So you have things about your returns. So if you have returns, if you have disputes, how do you object and all of those things. You'll find that information in the Nigerian Tax Administration Act. And of course, because of the expanded scope of FRS, now to be named Nigeria Revenue Service from 2026, so they've modified, the Establishment Act to provide for more powers to collect revenue for the Federation. And then, of course, you have the Joint Revenue Board Act that establishes the Tax Appeal Tribunal, and now have also introduced the Office of the Tax Ombudsman. Of course, basically just to aid, tax dispute resolution, right? So, um, we'll just go into it very quickly. Of course, with the changes, there has been several narratives, depending on who you are listening to about, the changes that have happened. Of course, there's a lot of discussion in the social media. Everybody has suddenly become a tax expert, and there are quite a number of misleading information, that are out there. I mean, the latest one I heard is that from January 2026, the government is also going to reach out for your account and debit it even without your knowledge. That's entirely is not correct. There's a process, to recovery of taxes. And I've seen some clients are already panicking to say, should I be moving my money out of the country? Tax is coming. What should I do? And all of that. So, like I said, what I've done is just to, identify some of the key changes, which I think, will be worthy of note. So the first is updated personal income tax band. So what does this mean? Um, what has happened is that prior to now, as an individual, there's a process to determining what your tax liability should be. Of course, you look at your income, you look at the reliefs and allowances that, have been allowed to you. And when you then get your total income, which is supposed to be subject to tax, the law says that, because it's a progressive tax rate, your first 300,000 will be taxed at 7%, the next 300 at 11, and then, of course, anything above 3.2 million will be taxed at 24%, right? So what has happened now is that for every category of taxpayer, individual taxpayer, the first 800,000 of your taxable income is going to be exempted from taxes. Now, after the first 800,000, the next band will then be 2.2 million, which will then be taxed, at the rate of 15%. Right. So you will see that the band has increased significantly, and even the rate has also gone up. But if you compare it to the old rate, for the people within that income bracket, there will still be some reduction in the taxes that they are supposed to pay. So, and it's why, again, I'm saying, most of the confusion to say that, oh, government will reach out to your account is actually not correct. But for the purpose of, this category of people, we're speaking to, I believe will most likely fall, in the high income bracket, So what's then important to know is that for those category of taxpayers, they are likely to see a marginal increase, in the rate of taxes that they are going to pay from January of 2026. So it means that if you are paying an X amount, it's then going to be elevated slightly, in line with the new act. So you then need to begin to look at, your tax affairs to say, what exactly will be the impact and what are the opportunities for you to optimize, your taxes. So that's one of the major change that will impact HNIs. The second change, which is in terms of the definition of resident and non-resident individuals. So for you to be taxable in Nigeria, you need to be deemed to be resident in Nigeria. Now, prior to now, in the old law, an individual is seen to be resident in Nigeria if he or she has spent 183 days in Nigeria. Now, the new tax act has kind of modified, the rules. Now they've gone ahead to define who a resident individual is and who a non-resident individual is, right? And for resident individuals, there are three criteria. So one is that if you are domiciled in Nigeria, or if you have a permanent place, available for domestic use, you will be considered tax resident in Nigeria. Or if you serve as a diplomat or diplomatic agent of Nigeria in another country, you will also be considered as a Nigerian resident, because chances are that you will be exempted from taxes, in the country of your posting. Now, the act went ahead to define who a non-resident individual is, right? And this is where perhaps I might need Kofo's legal background to help us interpret, right? It said that for you to be deemed to be non-resident, you should be an individual that is not domiciled in Nigeria. So clearly, you can see the opposite of that in the resident individual's definition. You must not have a permanent place available for domestic use. Of course, the reverse is also in that of the resident individual. And then you should not have a place of a habitual abode in Nigeria. No substantial economic and immediate family ties in Nigeria. Then you must not have been to Nigeria, for more than 183 days. And then, of course, you are not serving as a diplomat or diplomatic agent of Nigeria in another country. Now, to the extent that the law has defined resident individual and has also defined non-resident individual. Now, the potential mix-up here will then be to say, if I want to determine my tax residency, do I just consider if I meet the criteria for resident individuals, or will I look at it and say, if I meet any of the criteria for non-resident individual, then I will be considered, a tax resident in Nigeria. We're aware that, they are still working on some regulations that will provide additional clarity, but this is potential area of confusion, in terms of determining the tax residency of individuals. But be that as it may, I think what is important to draw out here is to say that we have a lot of individuals who have dual nationalities, right? And sometimes, they may not meet criteria for tax payment in Nigeria. In that instance, then we need to really look at your circumstance, look at your nationality, look at where the second or third nationality that you have, see what reliefs are available, and then take that into planning overall, as you plan your taxes and your investment plan. Right now,
I think Suleiman is experiencing a bit of network glitch. We lost
oh,
you for a second. Please confirm that you can hear me.
okay, yeah, I can hear you now.
Okay,
Apologies.
okay, that's fine.
Okay, can you see my screen now?
Yes, we can.
Okay, great. So I was saying that going into 2026 and beyond, that we're likely going to see a lot more transparency and information, about HNIs being available to tax authorities for the purpose of examining their tax status. And one of it that I was trying to make reference to is to speak about the fact that Nigeria has signed, what they call the Multilateral Competent Authority Agreement on automatic exchange of financial account information. So plenty English. What this means basically is that if you are tax resident in more than one country, right, the tax authority of both countries have the obligation to report the balances in your bank account, including details of the account. If you have insurance contracts, the financial institutions have obligations to report it. If you have mutual funds, you have assets under management, you know, I mean, all those investments that you have outside of the country that meet a particular threshold, the financial institutions have the obligation to report it to the tax authority in their jurisdiction. Now, if you are a part of this multilateral competent authority agreement, if you signed the agreement, then that information will be automatically exchanged, with the other country. So just for illustration purposes, assuming you have a taxpayer who is tax resident both in Nigeria and the UK, and has significant account balances in the UK, has a lot of investments, maybe with asset managers in the UK. The banks in the UK and the asset managers have the obligation to report to HMRC, and HMRC is going to exchange that information with the tax authority here in Nigeria. Right now, will they, on the basis of that information, just give you a tax assessment directly? No. But what that does is that it gives, the tax authority a lot more information about the income of the person in question. And then if you then bring it back home, domestically as well, now in the Act, there's also a requirement that both your bank verification number and your tax identification number must be linked, right? Now, what will that do again? It will also give the tax authorities visibility over your local bank accounts. So by the time they are then looking at your offshore bank account and the local bank account, they can have a broader view of your income. And then they can also have a basis to compare that to what you have declared in your tax returns, as well as, then check whether, the taxes that have been paid are adequate, right? So this point is really.
Hello, Suleiman. We can't hear you. I think he's having a bit of network glitch. We lost you again. I think your network is not stable.
Okay, let me just change the source of my network. One minute, please.
Right, thank you.
Okay, can you hear me now?
Yes, we can hear you.
Okay, great. Sorry, I've had to change this. Okay, so I think that point is really important about transparency, of financial information, and taxpayers being aware that they really need to take a second look, at their financial situation, and then make sure that there's adequate planning. Now, the next change is the changes that were introduced, with respect to capital gains tax, and this was one of the big change that is tending to almost cause discussion, almost on a daily basis, right? So, what has happened, is that currently the law that we have in place, we have a law that's called the Capital Gains Tax Act, and once you dispose an asset that is deemed to be chargeable, any gain that you make on that disposal will be liable to tax at 10%. Now, the change that has then happened now is to say that we are going to repeal that act called Capital Gains Tax Act. Or, I mean, from January 16, it's going to stand repealed. But instead, what we're going to do is then to say that when you make a disposal and you make a chargeable gain, that will have otherwise been taxed under the capital gains tax in the old regime, what's going to happen now is that you are going to add that as part of your total income that should be subjected to tax, and then an income tax rate will be applicable. So meaning that if you're an individual, the capital gains tax will then take the rate of your personal income tax rate, which maybe might be between 15 and 29%, 25%, depending on, the income band. For corporate entities, it will be 30%. So technically, what has happened is that taxes on chargeable gains that used to be taxed at 10% will now be taxed at 30% if you're a company, and maybe let's just say 25% for the HNIs. And this, is really, really, really a significant provision, that requires a whole lot of review. Now, in determining the assets, again, disposal of shares have also come under the purview of capital gains tax. They've always been, but what has happened now is that they've increased the threshold for exemption to 150 million, to the extent that the profit you make on that transaction is not up to 10 million, then it will be exempted from capital gains tax. But however, if your proceeds of the transaction is in excess of 150 million and you reinvest that amount in the shares of another Nigerian company, then it will be exempted from taxes. Now, the other important introduction regarding the capital gains tax is now the taxation of indirect transfer of shares, right? So if you have a holding company that is outside of Nigeria and you transfer shares in that holding company that is outside of Nigeria, but that transfer of shares leads to a change in the ownership of the Nigerian entity, then that transaction that is happening outside of Nigeria will be liable to taxes here in Nigeria. So basically what you will see from this provision is that the tax authority is now extending its taxing powers even beyond, the shores of Nigeria, to the extent that, the situs, the location of the asset is in Nigeria, then, they will also want to tax any gains that is made on that transfer. Now, but of course, again, what came with this law is to say, and it didn't used to be there, to say if, however, you made losses, there are capital losses, now you can also take them as deduction, in your income tax computations. Now, given this provision that has happened, I mean, that have been introduced, there has been a whole lot of discussion. And recently, the Fiscal Policy Committee more or less issued an additional clarification to say, for the purpose, your capital gains tax will typically be your the difference between your sales proceed and the cost of the asset. So they are saying that, in determining that difference for the purpose of capital gains tax, the cost base will be the market value of the asset as at 31 December 2025. So this kind of gave, so a lot of respite, because I mean the exposures will have been quite significant. Okay. I'll just try and move a bit fast. Okay, so I was just trying to use this diagram to illustrate what we meant by indirect transfer of shares. So you'll have a typical structure that you see with a lot of HNIs where you have maybe a trust or a ultimate holding company that's outside the country. There will also be an offshore holdco that will be outside the country. And that holdco would then own, subsidiary companies in Nigeria and potentially outside of Nigeria. So what the law is saying is that if there's any transfer of shares at the level of the offshore holdco here, that is owning interests in the Nigerian entities, right? And if that transfer leads to change in ownership of the Nigerian entities, then you are liable to, pay CGT on any gain that is being made at the offshore holdco level, right? So I just want to move a bit faster. So there's now the introduction of the effective tax rate, right? So prior to now, we had what we call minimum tax. So if you are making profits or your profits are minimal, you pay what's called minimum tax, right? But right now, that has been abolished and it's been replaced technically with what's called an effective tax rate. And what this provision is saying basically is to say that if you have a company, a Nigerian company that is making turnover of 50 billion, and your effective tax rate is less than 15%, then that company will be made to pay up the difference between what the effective tax rate is, just to top it up to bring it up to at the minimum 15%. And to the right, you see how to compute what that effective tax rate is. But again, we know that potentially there are HNIs here who also run companies that might have turnovers that fall within, this range. So this is really, really important to know because, I mean, once you do your computations and, you are not meeting that 15% effective tax rate, then you really will then have to look at how to make up the balance, of that amount. Now, there's also what's called the taxation of undistributed profits, right? And again, this is in line with, Nigeria also trying to, extend its powers to tax activities that has nexus with Nigeria. And the law is saying that if you have a foreign company that is controlled, by a Nigerian company, and that foreign company has not distributed profits to its shareholders, that the Nigerian tax authorities can actually look at the retained earnings or the profits of that foreign company and deem a portion of that dividend as distributed to the extent that in their view, that portion they are deeming as distributed will not materially or significantly affect the business of that other entity. So essentially what they are saying is to say that if you have subsidiaries of Nigerian companies abroad, that are doing business operations and are not distributing dividends to the Nigerian company, then the Nigerian tax authority can actually deem those dividends as being distributed and of course subject them to tax accordingly. So the third rule also it's similar, again seeking to look into non-resident companies that are controlled by Nigerian companies. So what they are saying is that if you have companies that maybe are subsidiaries of Nigerian companies, and those subsidiaries, again, their effective tax rate is less than 15%, right? The Nigerian parent company, will be made to pay the difference between, their tax rate and the minimum effective tax rate of 15%. So if you consider that there are quite a number of investment holding structures in jurisdictions that have minimal or no taxes, right? It will be very unlikely that their effective tax rate will be 15%. And what this law is saying is that the parent company here in Nigeria will be made to pay the top up in a way that, it brings the total tax rate to the minimum of 15%, right? Now, I think the point to note here is that, again, I think we need to do a review. Taxpayers need to do a review of their structure, how they are using structures to hold their asset and their wealth so that going into the future, you don't continue to see potential tax bills that will continue to deplete the wealth, right? Now, the next point to make here is what the changes with respect to the definition of a Nigerian company. So prior to now, the law sees a Nigerian company as a company who has been incorporated in the Corporate Affairs Commission here in Nigeria. And then, of course, that ends, as a Nigerian company. But now what this law is saying is that even if you are not incorporated in Nigeria, to the extent that your place of effective management or control is deemed to be Nigeria, you will be deemed to be a Nigerian company. And any income that that company is earning, will be subject to taxes in Nigeria. Of course, subject to the unilateral relief that will be granted to the company, right? So again, there are a number of offshore structures that are holding assets for HNIs, right? Those structures are purely SPVs to hold those assets. Now, the management and control of those companies will typically be, residing with either the directors who sometimes can be resident in Nigeria, right? And they kind of exercise control over that company, so um, technically, those kind of companies, what the law is saying is that they will now be deemed, to be Nigerian companies and, will be subject to tax, on their global income because they are seen to be Nigerian companies, right? The next point, I'm almost done, is in terms of disclosure of tax planning. So what the law is saying now is that should any taxpayer, plan to go into any transaction that will offer you some sort of tax planning opportunities, right? Then you have an obligation under the law to disclose to the tax authority to say, I'm entering this transaction, or I'm trying to do this reorganization, or I'm trying to merge company A and B so that, maybe if there's a tax asset here and there's profit here, you can then merge them and then minimize whatever it is to the extent that that arrangement or that transaction is going to confer any sort of tax benefit to the taxpayer. The law requires you that you must disclose that transaction to the tax authority, right? And of course, the law went ahead to kind of give explanation as to, what is it that they refer to as tax planning. So if you have any relief from tax or you're having some transactions for the purpose of avoidance and all of that, you should disclose. But we do know that, with those kind of disclosures, will come a number of scrutiny or additional scrutiny, by the tax authorities. So I think again, as we engage, with our tax advisors and all of that, we also need to have these points at the back of our minds, right? So it's not all taxes. I just also felt that, we should also include some notable exemptions that have also been granted, to individuals and companies under the new tax laws. Of course, there's the individual. So if you are earning a gross income, maybe of about 1.2 million, clearly that will result into about taxable income of about 800,000, on which, you'll not pay any taxes. So if you earn income of between 0 and 20 million, you will likely see minimal or no taxes or very reduced taxes. But of course, for those that are earning from 20 million and above as individuals, whether you're a business person or you are a salaried employee, then your taxes will slightly go up. On the capital gains tax side of it, so if you sell a house where you live, it will be exempted from taxes. If you have personal effects, that you also dispose, they will also be exempted. You're allowed to sell up to two private vehicles in a year. Once it's becoming more than two, then you are more or less becoming a car dealer and you will be paying taxes. But if you have two of your cars, yeah, you can sell them without taxes. We already talked about the shares. Once they are less than 150 million and the gain you are making on them is less than 10 million, it will also be exempted. On the company income tax side, there are small companies have been exempted. If you invest in label startup, they are also exempted. If you're into agribusiness, you will also be exempted from taxes. Those are on the VAT side. Most of the things that we consume have been zero rated, even though exempt and zero rated for businesses have different impact. But the point to note is that a whole lot of items, have been, you will not pay any VAT on them. They are either zero rated or exempted. Stamp duties as well. These are transaction taxes, right? So if you have money transfers below 10,000, it's exempted. Transfer of shares are also exempted from stamp duties. Salary payments and all of that are also exempted. Yeah, the point to note, which is very important also as part of planning for the future as well, is to say that penalties for non-compliance have more or less, been revamped. So there are quite a number of potential penalties that I think you need to be aware of, right? But I've just highlighted, a few here. So as a taxpayer, you need to register. If you don't register, there's a penalty. Now, if you are doing business with an unregistered person, right, and this goes mainly for companies, right? So if you have employees who don't have payer IDs or tax IDs, or as a company, you are awarding contracts to vendors that do not have tax identification number, for each of those transactions, you will be liable to penalty of 5 million naira each. So I think this is very important to mention so that before December 31st, it's important if we have companies to double check with the people that run those companies and make sure that every vendor has provided, their tax ID numbers. And if they don't provide them, then maybe you put, further transactions with those vendors on hold pending, when they provide it. Otherwise, you'll just be incurring penalties, for each of these vendors. So of course, every individual is required to file returns. Prior to now, the penalty wasn't very clear, but it's now very clear. It's 100,000 in the first month and 50,000 subsequently. And of course, the host of penalties are listed there in the interest of time. So what do I think are the next steps, that we should be considering? Clearly, with every change, the response by every individual will be different. But I think that what, taxpayers should be doing is to say, in all of this, right, what exactly is it that has changed? And I think one of the ways to understand what has changed is the kind of session that we're doing. And I say well done to the team at Codros, you know, but beyond what has changed, the circumstance of each individual will be different. The question then is to understand how these changes, impact your specific circumstances. What are your income flows? What are your residency circumstances? Where are you earning income from? What kind of assets do you have? How are you holding those assets? How are you investing? What are you investing? Those circumstances will differ as you move from one individual to the other. And that's why you then need to more or less do some kind of review to say, how will this impact, me personally or as a company? And of course, once you have a full understanding of that, you then need to take necessary steps to then begin to say, are there things I need to do now before this law comes to end to minimize this impact? Do I need to reorganize? Do I need to change certain transactions? Whatever it is, again, depending on your circumstances, you need to then, take urgent steps and make sure that you kind of take, precautions to minimize any adverse impact that it can throw up. And of course, always advisable to consult with a professional tax advisor who will guide you, through this journey. So thank you so much. I hope that I've not taken too much time. Yeah, go for back to you.
Thank you very much, Suleiman, for that insightful presentation. Thank you so much. It was very insightful. I believe that everyone has gained a clearer understanding on these new tax changes, and everyone is, getting better prepared. So we'll now move into the Q&A session. Please, if you have questions, kindly drop your questions in the Q&A box. We have some questions that's coming already, so we'll just take as many as we can as the time permits. So the first question here is so I'll just read questions out. The first question I can see here is the Data Protection Act in UK and EU prohibits the transfer of personal information of citizens to external jurisdictions. How would that affect the discharge of mutual obligations under the multilateral exchange of financial account information with Nigeria?
Yeah, so these agreements are actually signed between countries, right? Not companies. So it's the Nigerian government and the governments of other jurisdictions that have come together to sign, this act. And as far as I know, I think the National Assembly of each country more or less domesticates this agreement to give it force of law here in Nigeria. And I think the general, where you have those kind of bilateral agreements, most times they will trump the local agreement. So I understand what you're saying, but even in the exchange of information, there are very strict protocols for the transfer and sharing of information. So for Nigeria to receive those kind of information, for instance, there are quite a number of things that they need to do in terms of guaranteeing the safety and integrity of the data they receive, who views it. Even within the tax authorities, not everybody can. So there are a lot of protocols around protecting the integrity of, the information you receive. And if you don't meet those protocols, you will not receive any exchange of information. And that is certified globally. It's one standard for everybody around the world. It's not a different standard. So I think that they've thought through it, right? And they've taken safeguards to ensure that those whatever information is shared, remains confidential.
Okay, thank you very much for that clarification. So we have another question that just came in. So this person says, please provide more clarification on those who have income both in Nigeria and overseas. You gave an example of someone who has income in the UK.
So I think what to do if you have income, so it depends if you are a tax resident in Nigeria, and let's say you are earning income maybe from US, UK, or Canada, for instance. So as a Nigerian, the point to note first is that as a Nigerian tax resident, you are liable to tax on your global income, right? So irrespective of where you've earned that income, it will be liable to tax in Nigeria, except if the law exempts it. So there are categories of income that the law has exempted in Nigeria. So one, for instance, is if you earn dividend or interest income or rental income or royalties from abroad, right? If you earn any of those four categories of income and you repatriate that income to Nigeria through through the government approved channels, through your DOM account, they will be exempted from taxes. If you do not repatriate it, then you are supposed to declare that income in your tax returns in Nigeria and pay the appropriate taxes on that income. If you earn other classes of income other than these four that I mentioned, whether or not you repatriate them into Nigeria, they'll be liable to taxes here in Nigeria. So the point to do is then to say, as an individual, what type of income am I earning outside the country? And is there anything that I can take advantage of, within the law that exempts that kind of income? And if not, you then go back and say, is it a country that we have double tax treaties with, right? Then sometimes the double tax treaty can even provide for who to tax that kind of income. And then with the new tax act now, there's what you call the unilateral tax relief. That means that even if we do not have double tax treaty, if you have paid taxes, you can then take the foreign taxes as a credit against the Nigerian taxes. And if there's a balance to pay, then you pay the balance over to Nigerian government. So broadly, that's how you handle it. But again, like I said, you will need to review, the specific circumstances for a definite advice on what to be done.
Okay, thank you very much for that clarification. So there is a question here that says that are overseas pensions, e.g., NHS or state pensions in the UK for NRN or Nigerian pensioners with dual multiple citizenship taxable?
No, pensions are tax exempt, so you don't pay taxes on your pension.
Okay. So, from your own perspective, right, you've said a lot today, right? But from your perspective, what areas of personal finance or investment portfolios do you think would likely feel the impact of this new tax implementation?
Okay, so um, I think it just depends on how you are investing, right? So if you are investing in the stock market, for instance, in Nigeria, you're doing equities and you meet the threshold, provided in the law, then you are likely to be impacted, by that provision on CGT, that taxes CGT. That's one. If you earn dividend income, right, maybe from those stocks, now the law exempts dividends. It says as long as it has suffered withholding taxes from the person that is paying you, then clearly those would be exempted. Now, if you're earning, let's say you've invested in commercial papers, for instance, and you're earning interest income, even though that interest income will have suffered taxes, right? Again, it's not the final tax, so you'll have to pay up the balance. So I think that it depends on the type of income, the classes of investments, and the kind of income that you earn will then determine, whether there's exemption. For instance, if you're doing government bonds, those are exempted from tax. In the past, T-bills, for instance, used to be, exempted from withholding taxes, but that order that exempted them have expired. Now, T-bills are subject to withholding taxes. So, what will be important, but sometimes, right, tax alone is not the driver of investments. Sometimes returns on certain asset classes may even trump, the tax considerations. So it's to look at your portfolio and then understand the tax impact and then take an investment decision. I mean, an informed decision as to how, you want to design your investment strategy going forward.
Thank you very much. So we have another question here. It says, do you have any information on the possible tax that will apply to the mutual funds? I read 10% on interest in the news. How true is that?
Again, the question to ask is what kind of return or income do you earn from mutual funds, right? So because it's a mix of different classes of assets that the manager is investing in. So you'll have dividends, on from some investment, you will earn interest, there could be capital gains, but generally, those incomes, you're supposed to report them in your tax returns. And where the law allows you to exempt it, you exempt those category of income. For instance, dividends, for instance, will be exempted from tax. And then if you earn interest income and maybe rental, whatever it is, right, you then determine what taxes will be paid. But at the point of payment, you are likely to suffer withholding taxes, which will be a credit, for the tax payable at the end. You know.
Okay, thank you very much. So There's another question here. What if a resident Nigerian derives interest income on dollar-denominated investments domiciled outside Nigeria? What would happen?
Okay, so if you earn interest income, remember I said as an individual, if you earn interest income abroad and you bring it into Nigeria through your government approved channels, it will be tax exempt. If, however, you decide as a Nigerian tax resident to leave that interest income abroad, then you have an obligation to declare it to the Nigerian Tax Authority and then pay the appropriate taxes on that income.
Okay, so are retirees subject to payment of tax? For retirees, are they subject to paying taxes?
Well, if a retiree is doing is doing trade and is earning income, right? But so those incomes will be subject to tax. But if, however, what the retiree is earning, it's maybe income from their pension account, that income stream will not be liable to tax. But if he is doing active business and earning income, yes, he will pay taxes. There's no exemption that is based on age in the law. The tax laws just follow the money basically.
All right, thank you. So, someone is asking, I would like to ask if there are any plans for tax returns. How would this be processed?
Tax returns.
Yes.
So I want to believe maybe the person asking the question is talking about refunds, right?
Yeah, I think something like that. Yes.
Yes, I want to believe they are talking. So right now, the way our tax laws, have been drafted, refunds are only available to corporate entities, right? Because there are instances where, you as a corporate entity, you can be in a refund position. Of course, for instance, when your clients are paying you, they take withholding taxes. Sometimes you don't make enough profit to offset it, so you can be in a refund position. Sometimes, depending on your business, right, you may be suffering input VAT. That means when you buy goods and services, you pay VAT. But maybe your products are VAT exempt or zero rated, so you don't have any VAT to net off. So you might be in a VAT refundable position. So yes, and that mechanism is there in the Nigerian Tax Administration Act as to how you can apply for refund, the timeline, the process, and all of that. But for individuals, I'm not sure the law currently provides for refunds to individuals, because what has been done is the law says that to determine your tax payable, take your income, grant the reliefs and allowances that have been provided in the law, and then whatever you have as the balance then becomes your taxable pay. So it's unlikely that in Nigeria you will be in a refundable position as an individual.
Okay, thank you very much. So, talking about VAT, there's a question here that says that for a small company operating inside a physical market and selling to customers as they come, how do you comply with VAT registration requirements for them? You mentioned initially that for business owners that does not comply, there are penalties. So how does this person comply with VAT registration requirements for customers in a physical market?
For customers.
Yes, for customers. As so,
So,
like the
so,
person
so,
is
so
operating
small.
in a
So
physical
I
market.
yeah, so I assume that's a small business that is doing buying and selling. So the VAT Act already exempts small businesses from VAT compliance, right? So if you're a small business doing your trading in the open market, then you will most likely be unable to. I mean, you are exempted from VAT, right? But if you are even doing a business, for you to be able to, charge VAT, you need to have registered with the FIRS. And currently, as an individual, the law does not permit you as an individual to charge VAT, right? So Because if you charge VAT as an individual, recall that you are only an agent of collection on behalf of the government, right? It becomes a bit difficult to trace you, then for you to remit and all of that. But of course, companies, incorporated entities, have to register for VAT, charge, and then remit. But as an individual, you can't, charge VAT. So if you're an individual doing business in the market, you don't have business with VAT. If you are also a small business, even if you are incorporated but a small business, you are also exempted from VAT as well.
Okay, so there's also a very interesting question here. It says, how does it impact those with business name compared to those with limited liability companies?
Okay, so with business name and limited liability, so there are two kind of taxes that you need to pay attention to. One is the taxes on the income from the business, and the other is the transaction taxes, right? So as a business name, lawyers have told us that the partner and the business are one and the same, right? So the entity is seen as a tax transparent entity, meaning that that business name as a business name does not pay tax, but it is the owner, this either the partners in that business name or the sole proprietor, that will actually pay the taxes on the income made by that business name. So, and that tax will be personal income taxes because it's the individual that is paying it. However, for corporate entities, the company itself will pay its taxes, right? And then whatever is left is then given to the shareholders as dividends. So that's in terms of taxes on the income that is being earned. But depending on the businesses that you are doing, as a registered business name, you can charge VAT. So depending on your turnover, if you are doing turnover above the threshold, then you need to register for VAT and charge your customers VAT. When you are paying your vendors, you need to deduct withholding taxes and remit. And that is similar and same for a limited liability company as well. So I'm hoping that I've kind of answered the person who answered that question.
Yeah, surely you've done so. So, someone is asking, what is the time frame for a company to file its yearly tax? Is there a time frame?
Yes, so there's a time frame. So it's 6 months after your financial year ends. So if your company's financial year end is December, right? So it means that your tax returns for a company will be due by 30th of June of 2026. If your year end is March, it will be due in September. If your year end is September, it will be due in March. If your year end is June, your tax returns will be due in December. So just whenever is your financial year end, it will be 6 months after that, on or before 6 months after that.
Okay, thank you very much for that clarification. We have another question here. It says that how is or who access the profits for a capital gain tax? So who is the person that will access the profits for a capital gains tax and how will it be accessed? I think that's what the question is about.
Okay, so the question to ask is who is making the capital gains, right? So let's say I buy a house for 1 million, right? And at the time I'm selling it, the price or the value of the house has appreciated. Maybe I sell it for 1.5 million, right? So I've made a gain of 500,000. So the capital gains will most times be made by the person that is disposing the assets, right? He is the one that is making the gain, and then the liability to pay the taxes will be that of the person that is making the sale.
Okay, that's fine. So if I hear you correctly, the person making the gain is the person to pay the capital gains tax.
Absolutely.
All right, thank you. So you also said a lot about we need to start preparing, get our documentations ready, get the payer ID, right? So what other documentations or financial record do you think that individuals should start organizing now ahead of this implementation? What should they start getting ready?
Yeah. So I think taxpayers need to begin to take a second look at their business, right? And then even say, from this business, what exactly is my compliance obligation? So obviously, as you transact on a day-to-day basis, before your accountant books those entries into your account, you're supposed to have your source documents, be it invoices, contracts, whatever it is, that formed the basis for those transactions. Now, you need to begin to put those things together. You need to begin to review your portfolio. So if you are earning income, so where is the income going? You need to begin to look at your bank statements. You need to look at every financial record that speaks to your income and expenses, because most times, if you're an entrepreneur, you'll be taxed based on profits, and you will need to, keep sufficient documentation regarding your income and expenses, which will then be a basis to support whatever profits that you have declared for tax purposes. So I will say that your accounting records needs to be kept intact. You need to take inventory of your assets. You need to take proper inventory of your investments. You need to look at your sources of income. Where are you earning income from? Are you earning income from Nigeria? Are you earning income from abroad? If you're earning income, where are you earning those income from, and all of that. And then have a holistic view, of your either net worth of income, and then determine where should you pay taxes. There could be instances where you are liable to tax in more than one jurisdiction. You need to make sure that overall, for the purpose of the wealth that you are trying to manage, you don't overexpose yourself to penalties arising from non-compliance or complying wrongly. And that's why in my closing statement, I did say that you need a qualified tax practitioner, depending on the jurisdiction, to support you. Don't do it alone, except if you are an expert like Kofo.
All right, thank you so much. So we have a lot more questions coming in, but we'll just take like two or three more because of time constraints. So I'll just read them out. So one of them says that, can you reiterate the provisions on gain on foreign domiciled investments?
On foreign what?
Domiciled investments. Can you reiterate the provisions on gain on foreign domiciled investments?
Oh, okay. So I believe maybe the person is speaking with respect to my comment about indirect transfer of shares, maybe outside of the country. If you can explain, but if that's what it is, so just imagine you have a Nigerian company that is owned, let's say, 100% by maybe a company in, let's say, Mauritius, right? Now, what happens usually is that when, let's say, the Mauritius company, wants to get investors, you will maybe not see investors coming directly into the Nigerian business, right? Maybe the investors will invest at the level of the holdco. So the existing shareholders will cede, a portion of their shares to the investors. So what the law is saying is that if you do that, right, that you are going to change the ownership of the Nigerian entity. Remember that the holdco owns the Nigerian entity 100%. So if you move those shares to somebody else, you already have altered the ownership of the Nigerian entity. Now, that person that is selling those shares, if he makes any gain on those shares that he's selling to investors or to another party, he will be liable to taxes in Nigeria because of the reason that the underlying assets that is giving value to that holdco is actually a Nigerian business, it's a Nigerian asset. You then have to pay your taxes on the gain that you'll have made on that. So I believe if that's not the area that the person is looking to get response to, please feel free to let me know.
Okay, so we'll be taking two more questions. Someone says that there is now withholding tax on interest on treasury bills. Is that correct?
Yes, it's correct.
Because I know you mentioned that there's now the exemption has been lifted, so there will be withholding taxes on treasury bills now.
Yes, correct.
All right, thank you so much. So finally, the last question is, if you had to summarize one key takeaway for participants today, what would it be?
Um, so I will say you need to understand and respond, not react. Because if you respond, then you most probably will have thought through your reactions properly. But if you just react, it's at the spur of the moment. So I will say understand the changes, and then respond accordingly.
Thank you very much for, answering all the questions asked. So we had so many questions that we couldn't take. But for the other questions that we couldn't take, please note that if you like to schedule a one-on-one session with the Anderson in Nigeria team, we are very available to, help you facilitate that session. And you can reach out to us on our email at cordroswealth@cordros.com, or you can also reach out to any of us. My colleagues would Okay, you can reach out to any one of us here, and we'll be happy to facilitate the session, to connect you with the Anderson in Nigeria team for you to get more guidance on how to better prepare yourself for 2026. We hope that you've had such an insightful time and you've learned a lot, and we appreciate your time. Thank you very much for joining us despite your busy schedules. This is the end of the webinar. Do enjoy the rest of your day. Thank you. Thank you, everyone.
Thank you, Kofo.
Thank you for your time.
My pleasure.